Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, residual income valuation. And what we will do in lesson 2, we will build on what we have done in lesson 1. More precisely, what we will look at, and we are still looking at residual income valuation. What we will look at the residual income model, Then once we've looked at that, we will look at more precisely, we will look at the model itself, model based on an example, like that. So once we've looked at that, we will build on this and look at the fundamental determinants of residual income. Fundamental determinants of residual income. There. Once we look at the fundamental determinants of residual income, we will move on and look at the intrinsic value of common stock. Intrinsic value of common stock. And once you look at the intrinsic value of common stock, we will now look at an example, like that. Once you look at the example on the intrinsic value of common stock, we will move ahead and look at the implied growth rate. Implied growth rate. Like that. Now we'll be able to now derive the implied growth rate from the intrinsic value of common stock, right there. Then we will conclude this session by looking at the calculation of residual income based on a multi-stage model. So the residual income valuation based on a multi-stage valuation. Rather, not valuation, based on a multi-stage model. There. Now, this is what we will look at, and we start off without any delay by looking at the residual income model. Residual income model. Like that. Now, the residual income model is as follows. So, the value of a share or of a security is given as B0 plus RI 1 over 1 plus R 1 plus RI 2 over 1 plus R 2 plus RI 3 over 1 plus R 3. So we continue like that. RIN over 1 plus R N, like that, where V0 is the value of a security. Then we have B0 is beginning book value. Beginning book value. Then we have the RIN is the residual income. At time or period at time N there, and R is required return. So having defined that, let's look at an example right there. So we looked at the residual income model. Let's look at the example right there. So the example reads as follows. Consolidated Pipe Products has a required rate of return of 14%. The current book value is 6.5. earnings forecast for 2009, 2010, and 2011 are 1.1, 1, and 0.95 respectively. Dividends in 2009 and 2010 are forecasted to be 0.5 and 0.6 respectively. The dividend in 2011 is a liquidating dividend, which means that Consolidated will pay out its entire book value in dividends and cease doing business at the end of 2011. Calculate the value of Consolidated's stock using the residual income model. So what we'll do, we will use this residual income model to try and solve for this question. So we need to first of all get the corresponding residual income for period 1, period 2, and period 3, and so on like that, if any. So that now we can now apply the beginning book value here. We get the residual income and discount it like that. So this component is the beginning book value. The RI1, RI2 discounted against 1 plus R represent the present value of future expected residual incomes right there. So to solve, we first of all begin. So we say solution. There we can see we have been given the beginning book value per share. So beginning book value. So we have here 2009, 2010, 2011 there. So the beginning book value for 2009 we have been given as how much? We have been given as 6.5. So 6.5 has been given to us there. Once we have the beginning book value, recall, I can put over here, recall what we had said. We had said that we get the beginning book value, we add the EPS, and then you less the dividends, so that we can be able to get what? The forecasted book value. That's exactly what we're going to do right here. So we get the beginning book value, we add the earnings per share or the earnings component. So we say add the EPS, if we have any there. We have been told that the earnings forecast for 2009, 2010, and 2011 are 1.1. This we've been given 1.1. We've also been given 1, 1.0, and here we've been given 0.95. Once we add the EPS, we now less the dividends. We less the dividends. Once we less the dividends, we should be able to get the forecasted book value. Forecasted book value. So the dividends are how much? We have been given the dividends in 2009 and 2010 as 0.5 and 0.6. 0.6 like that. So this should be put in brackets like so that we can be able to know that we're deducting that component of dividends. And then how much do we get as the forecasted book value there? So we very quickly compute. We have 6.5 minus, rather 6.5, we add 1.1, and then we less 0.5 like that. We have 7.1. 7.1. Now once we have 7.1, this 7.1 comes right over here. So I can put it faintly like that. So we have 7.1 like that. 7.1. We add 1, then we less 0.6 there. We have 7.5. So we can put faintly again there. This comes here 7.5 like that. Because it's forecasted book value. So it is the forecasted book value for the next period. So we have now 7.5. From the information, we may not have been given the dividends there. But we've been told it is a liquidating dividend. It is a liquidating dividend, meaning that it will pay its entire book value right over here. Meaning that this component over here, all the forecasted book value, we should be 0 there. So we are saying it will be 7.5 plus 0.95 like that. We get 8.45. So it should be 8.45. Which should be added there. So this component plus this one minus this 8.45 should give us 0. So it should pay out its entire book value in form of dividends, like that. Now, once we've computed the forecasted book values there, now we proceed and get the residual income. Recall what we are saying is that to get the residual income, we have residual income is given as net or the earnings times the cost of equity, which is the required return, multiplied by the book value of equity, like that. That is what should be at the back of our minds. We know that getting the residual income, we have the earnings, we multiply that by we multiply that by the product of the required return and the book value of equity, like that. So once we get that, I think I might have made a slight mistake. This should be minus. You said net income or the earnings less. This should be less right over here. Apologies for that. Don't worry. Human is to error. So it's the earnings less the equity charge right there. So that is what we're trying. We have the earnings over here. Now we need to get the cost of equity times the book value of equity. So for 2009, we can just do it over here. 2009, 2010, and 2011. So 2009, we have the cost of equity times the book value of equity. The cost of equity, based on the information given to us, we have the required rate of return as 14%. So 0.14, 0.14 multiplied by what? Multiplied by the book value, the beginning book value, not the forecasted book value like in 2009, not this value, but we will be getting the beginning book value times 6.5. How much? This one times 7.1. This one times 7.5. 7.5, like that. So how much do we get there? Very quickly. So we have 0.14 multiplied by 6.5. 6.5, we have 0.91 for 2009. So you can come over here and say less equity charge. Less the equity charge, like that. So we have 0.91, like that. Then we have 0.14 multiplied by 7.1. We have 0.994. So we have 0.994, and we are going to less that. And finally, 0.994. Then for 2011, 0.14 multiplied by 7.5. 7.5 is the beginning book value. 7.5, we have 1.05. 1.05. Now we can come and rub off this right here so that we can be able to compute the residual income. Right here. So these ones with stars or with asterisks, if you wish, are the ones we are focusing on. So it's rather the earnings, not that one. It should be the earnings. Apologies for that. That is what we are focusing on, because you are saying the earnings less the equity charge gives us the residual income. So it's 1.1 in this case, 1.1 minus 0.91, 0.19. There. Then we have 1 minus 0.994. 0.006, 6, like that. Finally, 0.95 minus, this should be minus 1.05 minus 0.1, like that. Now, applying this residual income model, you are being informed that this is the value of the share. So we get the beginning book value, we add the respective residual incomes. As you can see, we already have the respective residual incomes there. RI1, RI2, RI3 discounted against 1 plus R will give us the value of the company's share. So to get the value, we say the value based on the formula is given as B0 plus RI1, which you're saying here, we don't need RI1 over 1 plus R, yes, plus RI2 over 1 plus R. I was initially thinking that we do not need to write it again. Let's just rewrite it for purposes of consistency. So Ri3 over 1 plus R power 3, like that. So the beginning book value, we have the 6.5 plus the residual income is going to be 0.19 over 1 plus 0.14 power 1 plus we have the 0.006 over 1 plus 0.14 squared there, plus we can come down over here and add since this is showing negative here, so we less 0.1 discounted against 1.14 cubed. So how much do we have there? So we have, let's first of all work out the present value of future residual income. So 0.19 divided by 1.14, 0.166. So we have 0.166 there. We add, of course, we'll consider adding the 6.5 here. Right here, the 6.5, we will be able to put it there. So we have 0.006 divided against 1.14, 0.006 divided against 1.14 squared. We have 0.0046, 0.0046. Then we add, we minus, we can just less this component, discounted value. 0.1 divided by 1.14 cubed, we have 0.067. 0.067 there. Then we add now this 6.5 here, the 6.5 like that. How much do we get? We can come over on this side here so that we can become very consistent in trying to get correct values. So we come here, 0.067, we add 6.5, then it's 0.166, we add 0.0046 there, then we less 0.067, then we add 6.5. We have 6.60. V naught is given as 6.60 there, shillings. That is the value based on residual income and valuation. Now we can move on and look at something else. Since we've done we try and identify, since we've done the model, the residual income model based on an example, we now move ahead and look at the fundamental determinants of residual income. Fundamental determinants of residual income. Now, in trying to identify the fundamental determinants, what we're saying is important is that we need to know that the value of a share is given as B naught plus. Now, the present value of future economic profits right there. So we say ROE minus R times B naught discounted against R minus G. This is what we're saying is R the fundamental determinants of residual income. Looking at this formula over here like that, we say the value right here is given as the beginning book value plus the present value of future residual income. So RI1, RI2, RI3. But now we are saying that the residual income will have a growth factor there. That is why we are saying that growth rate is what we are going to factor in this equation right here. And notice this, it is analogous, it is similar to the DDM, like that, DDM, or rather GGM, we put it GGM, Gordon Growth Model, where we have D naught 1 plus G over R minus G. It's almost similar to that. The only difference is that this component is the residual income. That is the only difference between the two equations right there. Remember, recall, we say that residual income is given as, or RI is given as net income less equity charge. There. We also say that residual income is given as the earnings less the equity charge. The equity charge component is R times the required return times beginning book value. Book value. Like that. We also said that residual income is given as ROE minus R times B naught, or beginning book value, like that. So multiply ROE, or return on equity, minus the required return times the beginning book value gives us the residual income. And notice this is what we've just done over here. So we can also say, once we've tried to understand all of this, we can also say that V naught is given as B naught plus RI over R minus G, like that. This is almost similar to this one. The only factor is that the RI1 power 1, power 2, power 3, and power 4. Now, considering the growth rate in residual income, we have factored that growth rate in residual income over here, and that's why when we deduct it from the required rate of return. This is what we are saying is a capitalization rate. Capitalization rate is the difference between the discount rate and the growth rate right there. So, we can say that the determinants of residual income include, number one, the beginning book value, that, and then number two, what we can say, the present value of economic profits. Present value of economic profits. That the present value of economic profits is this component right here. The beginning book value is just that component right there. So having looked at the fundamental determinants of residual income, now we need to try and see if you can be able to apply that concept by looking at an example like that. So let's look at the fundamental, let's look at an example right there. Now the example that I have here reads as follows. Western Atlantic Railroad has a book value of 23 per share. The company's return on new investment, ROE, is 14% and its required return on equity is 12%. The dividend payout ratio is 60%. Calculate the value of the shares using single-stage residual income model and the present value of expected economic profits there. So the first, we need to calculate the growth rate. We try and identify whether we've got all of the inputs that are required to compute the value of a share. So the value of the shares. So we say solution there. V naught is given as B naught, which is the beginning book value, plus ROE minus R there times B naught over R minus G, like that. So which you're saying, do we have the B naught? What do we have? We have been given the ROE, which you're saying is 0.14 or 14%. The required return, that is R, is being given as 12% there. And the dividend payout ratio is 60%. Dividend payout ratio 60%. There, what else have we been given? We've been told now the book value also is 23. Book value is 23, like that. So we have the beginning book value, yes, we have that. The ROE has been given, the required return has been given, the book value has been given, the required return has also been given there. What we don't have and we need to compute is the G. Recall in the dividend discount model or discounted dividend model, what we said is that G is given as small b times ROE. This is the component of the retention ratio. B retention ratio, like that. So we need to recall this. So what we have is 1 minus b, because if b is a retention ratio, 1 minus b is the dividend payout ratio, like that. And we have it right here as 60%. So to get the retention ratio is just 1 minus 0.6, so that we can be able to get the retention ratio like that. So we are saying we have 1 minus b is equals to 0.6, like that. To get b, we take b on this side and we take 0.6 on this side. So it's 1 minus 0.6, which is saying 0.4, which is the component of b. So we already have the b as 0.4 right there. And we already have the ROE as 0.14. So that means we can be able to calculate the component of the growth rate right there. So putting it all together now, G is given as B times ROE. B, or 1 minus B, which is 0.6. That means B is equals to 0.4, or 1 minus 0.6, which is 0.4. G is given as B, which is 0.4, multiplied by the ROE, which has been given as 0.14. How much do we have as the growth rate there? So we have 0.4 multiplied by 0.14. We have 0.056, or we are saying 5.6%, like that. That is the G. Now we now have all of the inputs. Let's put it all together. Putting it all together will assist us in computing the value of the security. So we have the B naught as how much? The beginning book value is 23, plus the ROE, we have it as 0.14, minus the required return 0.12, multiply that by the beginning book value of 23, discounted against the required return, which is 0.12, minus the growth rate, which you've computed over here, 0.0056 there. So how much is the value we have? Now, we first of all work out the present value of future economic profits, which is saying 0.14 minus 0.12. But remember, board mass, we first of all work out with the brackets. 0.14 minus 0.12, and we have 0.02. Then we multiply by 23 right there. We have 0.46. So it's 23 plus 0.46 over 0.12 minus 0.056. We have 0.064. How much? So we have 0.46 plus divided by, 0.064. We have 7.187. 23 plus 7.1875 plus 23, we have 30.1875 shillings. That is the value of the share of that security there. Now, we've also been asked to compute the component of the present value of future economic profits. Now, the present value of future economic profits is just the 7.1875, which is that portion right there. Now, we have now looked at how to compute the the fundamental determinants of residual income. There we've also done an example. Now the intrinsic value of common stock, this we can be able to say the intrinsic value is almost similar to what we've actually done right over here. Together with an example, we can be able to just combine this and the fundamental determinants of residual income. I've already explained the fundamental determinants. It is just the beginning book value and the present value of future economic profits there. So I've actually combined this bullet here and also this other hyphen rather, and this other hyphen right over here, together with an example right there. So we can be able to see our progress there. Now, the implied growth rate is the next step there, or the next stopping point. Implied growth rate. Implied growth rate. So, the implied growth rate is given as the V naught. We can be able to just solve for the component of G right there. That's what you're trying to do by getting the implied growth rate. So we have V naught is equals to B naught plus ROE minus R, like that. Then you multiply by B naught, or the beginning book value, discounted against R minus G. We say this is the cap rate component there. So we have, now solving for G, we have V naught minus B naught is equals to ROE minus R, like that, times B naught over R minus G, like that. So cross multiply can come on this side here. On cross multiplication, we have the following. We have V naught minus B naught on that side, and then R minus G, like that, is equals to ROE minus R multiplied by B naught. We are interested in G, so there is no need for us to open. We just divide both sides by V naught minus B naught. So we have R minus G is given as ROE minus R times B naught divided by V naught minus B naught there. Now we are interested in G. Let G go on this side. We do not want a negative G, so G goes on this side and this whole component comes on this side. So we have R minus ROE minus R times B naught over V naught minus B naught, like that, is given as G. So that is solving for G. So G is given as R, required return minus ROE minus R times B naught divided by the value of the share minus B naught there. So let's try and look at an example that can be able to apply that equation there. You are considering to purchase the Telus telecommunication company, which has a price to book ratio of 2.5. ROE is expected to be 13%. The current book value per share is 8, and the cost of equity is 11%. Calculate the growth rate implied by the current price to book ratio. So we are saying we are applying this equation. We are trying to identify the G. Let's see what we have. So solution, we see, do we have R? R, the required return, price to book ratio to be 13%. ROE is 13%, and the cost of equity is 11%. ROE, we've also been given the ROE as 13% there. We have been given the value of the share. Do we have the value of the share? No, we don't have the value of the share, but we have the price. That one we don't have there, but we have the price to book value. And we've been given there as how much? We've been given as 2.5 there. But it's okay. We can be able to solve for the market price. P represents the same as the value there. Let's see if we have the book value. The current book value per share is 8. So book value per share, we've been given as 8. So we have the denominator in the price to book value ratio. We have the denominator and we have the price to book ratio as 2.5. So on cross multiplication, we multiply 2.5 by 8, we will be able to get the price. Let me put it into perspective clearly over here. We have the price to book value ratio, which has been given. The price to book value ratio has been given as 2.5. The book value per share has also been given to us there as how much? As 8. So if we multiply 2.5 by 8, we will be able to get the market price per share. And that is what we'll be able to slot in as the value there. So let's just do that. 8 times 2.5, let's just see. 8 multiplied by 2.5, and we have 20 there. So P is equals to 20. So you can slot in over there. We remove that question mark there, and we put here 20, because we already know how the value of the share is. Now, can we be able to get the, we have the R we have the ROE, we have the R, we have the beginning book value. Yes, the book value per share. Do you have the value? Yes, we have the beginning book. We can be able to get now the growth rate there. So how much is the growth rate? So R we are saying is 0.11 minus ROE 0.13 minus R 0.11 times beginning book value. Beginning book value is 8 divided by, we have the value as 20 minus 8. You can see the book value there as 8 there. So how much do we have? So we will first of all work out this component. So 0.13 minus 0.11 there, then multiplied by 8, there we have 0.16 divided by 20 divided by 12, 0.0133. So it's 0.11 minus 0.0133. 0.0133. We have how much there? 0.11 minus 0.0133. We have 0.0967. Or we can say 9.67%. That is what we're saying is the implied growth rate right there. Now, to conclude this second lecture, we are going to look at how to calculate the residual income based on the multi-stage model there. Having built all of these concepts right up to that point where we have the implied growth rate right there, we need to look at the residual income valuation based on a multi-stage model there. If we look at what we've actually learned, we can be able to just say, okay, the residual income is given as the present value. So we have the beginning, or rather the value. Sorry. Just say the value is given as Ri over 1 plus R, 1 plus Ri over 1 plus R, to and so on and so forth, which has now been zeroed down into V naught is given as here there should be B naught, the beginning book value. Apologies, need to have the beginning book value right there. So we are saying that we are building on this B naught plus Ri over 1 plus R plus Ri 2, 1 plus R 2, and so on and so forth. Beginning book value, present value of expected future residual income, which narrows down now to V naught is equals to B naught plus ROE minus R times B naught over R minus G. That. So we will be trying to identify the corresponding residual incomes so that we can be able to get the value of a security. Let's look at an example that can be able to apply and calculate the residual income with multi-stage model. Let's look at it from here. So residual income with multi-stage model. There. So let's look at an example. Java company is expecting an ROE of 15% over each of the next 5 years. Its current book value is 5 per share. It pays no dividends and all earnings are reinvested. The required return on equity is 10%. Forecasted earnings in years 1 through to 5 are equal to ROE times the beginning book value. Calculate the intrinsic value of the company using the residual income model, assuming that after 5 years, continuing residual income will fall to 0. So what we'll need to do, first of all, is to draw the information based in form of a table. Once we have that table, we can be able to do the following. So we say solution, right there, the year, there. We have the earnings, E. Then we have the ending book value, ending book value, like that. We can draw it in form of a table like that. Then once we have that, we also require the ROE given to us there, like that. And then the equity charge, like that. And then finally, we have here the residual income, RI, like that. So this is the best way we can be able to solve this question. So we have how many years, how many periods? We have to go through, and we've been told up to 5 periods. So we start with 0, 1, 2, 3, 4, and 5, like that. And we're being told that the ROE is 15%. So in this column right over here, we can just confidently put in percentage 0.15, 0.15 all through, 0.15, 0.15, apologies, not there. So we put it corresponding 0.15, 0.15, 0.15, 0.15. And so that one remains constant. For the next 5 years, its current book value is 5 shillings per share. Currently is year 0, is 5 there. It pays no dividends and all earnings are reinvested. The required return on equity is 10%. That one we'll be able to use it when we are discounting it at that point over here where we have R, the R component. For the 5 years, we'll be able to discount it against the 10% there. Then the forecasted earnings in years 1 from here through to 5 are equal to the ROE times the beginning book value. So for us to get the forecasted earnings right over here, we will multiply this component for year 1, 0.15 times 5, so that we can be able to get the forecasted earnings. Let me repeat that again. We are being told here that the forecasted earnings in years 1 through to 5 are equal to the ROE multiplied by the ending book value, which gives us the forecasted book value right there. So can we be able to do that moving ahead? So we have 0.15 multiplied by 5. How much? 0.75. There. For us to get the ending book value, recall what we said. We first of all started with the book value, the beginning book value. We added the earnings, EPS, and then we less the dividends so that we can be able to get what? The forecasted book value right here. Forecasted BV right there. So it's beginning book value, we add the EPS, we less the dividends, we get the forecasted book value component there. That's exactly what we're doing. So we are saying that once we have the ending book value, there and the forecasted earnings there. So we are saying it's the beginning book value plus the EPS. If they're dividends, we less them, and then we get the forecasted book value, which we're saying is going to be over here. So the ending book value, this, then we add this should give us the component over here of forecasted book value. So in this case, we are saying it is 5.75. Can we be able to forecast this value here? Yes, we can for the year 2. 0.15 multiplied by 5.75 should give us that value there. So we're saying 0.15 multiplied by 5.75, 0.8625. 0.8625. So this component plus this should give us that. So plus 5.75 should give us 6.61. This times that 0.15 times 6.61, 0.992. Like that. This plus that, then you say plus 6.61, 7.60. This times that 7.6, apologies, 7.6 multiplied by 0.15, 1.14 plus 7.6, 8.74 multiplied by 0.15, 1.31 plus 8.74, 10.05. Now we've done the estimates over here. Now the equity charge, we had said once we had got to the forecasted book value, we had said the equity charge is just gotten by getting the required return, which you're saying is R multiplied by not the forecasted book value, but by the beginning book value there. The beginning book value right there. So in this case, the required return is how much? From the question, we are saying we have the required return given to us as the required return is 10%. So 10% times the beginning book value. So it's just to focus for this one over here, it's just 10% of the beginning value, not of year 0. Yes, not of the corresponding value here, but of the beginning book value. 10% of that, we say 0.5 there. 10% of this one is 0.575. 10% of 6.61, 0.661. 10% of 7.6 is 0.76 there. Then 10% of that is 0.874. 874. Can we be able to get the residual income? Yes. The residual income is just given as the earnings or the EPS less the equity charge. The earnings, so it's this one minus this one. This one minus that, like that. So we continue like that. We say it is the earnings 0.75 minus 0.5, 0.25. 0.8625, 0.8625 minus 0.575, 0.2875. Then we have 0.992, this one minus 0.661, 0.331. Then we have 1.14 minus 0.76, 0.38. Finally, we have 1.31. We minus 0.874, 0.436, 6 like that. Now these are respective residual incomes. Once we have that, now we just combine them based on this formula right there, so that we can be able to get the value of share. So we have RI is given as the beginning book value is how much? The beginning book value is 5 plus now the respective present value of expected of future residual incomes, 0.25 over 1.1, it's 10%, 1.1 power 1 plus 0.2, let's say 0.29 divided by 1.1 squared plus we have 0.33 divided by 1.1 cubed plus we have 0.38 divided by 1.1 power 4 plus we have 0.436 divided by 1.1 power 5 right there. So how much do we have? So 0.25 divided by 1.1, 0.227 plus 0.29 divided by 1.1 squared, 0.24, let's say 0.24 plus we have 0.33 divided by 1.1 cubed 0.25 plus then we have 0.35 divided by 1.1 power 4, 0.24 plus we have 0.436 divided by 1.1 power 5, 0.27. Then we add now this beginning book value plus 5. So how much do we have as the intrinsic value? So we have 0.227 plus 0.24 plus 0.25 plus 0.24 plus 0.27. Then we add 5. 6.227. 6.227 shillings. That is the value based on residual income there. This comes to the end of our second lecture under residual income. We hope that you'll be able to join us for the third lecture under residual income as well. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.